If you're thinking about buying a home in America or already paying a mortgage, this video could save or cost you hundreds of thousands of dollars. In 2026, mortgage rates are not just numbers on a screen. They decide who buys a home, who stays renting, who builds wealth, and who gets trapped in debt. Most Americans do not understand how mortgage rates actually work. They just trust banks, headlines, or real estate agents. Today, we will break everything down. Why mortgage rates are high, what the Federal Reserve is really doing, fixed versus adjustable loans, who should buy a house in 2026, and what mistakes can destroy your financial future. Watch till the end because most people make the wrong decision at the worst time. A mortgage rate is the interest you pay the bank to borrow money to buy a home. Sounds simple, but it's not. Example: home price for $100,000. Down payment $80,000. Loan amount $320,000. If your mortgage rate is 3%, you pay till the $165,000 interest. 6% you pay till the $370,000 interest. 8% you pay more than the house itself. Same house, same loan, different rate. That's why mortgage rates control your future. Mortgage rates don't come from banks. They come from the Federal Reserve. What happened? COVID money printing. Trillions injected into the economy. Inflation exploded. Fed raised interest rates aggressively. The Fed's goal not to help you buy a house, to slow down spending. High mortgage rates are intentional pain. Inflation roof, food up, rent up, healthcare up, insurance up. To fight inflation, borrowing must become expensive. That's why 3% mortgages are gone. 6-7% is the new normal. 8% plus is possible. Fixed versus adjustable mortgages. Fixed rate mortgage. Same payment for 30 years. Safe. Predictable. Higher starting rate. Best for families, long-term homeowners, risk-averse people. Adjustable rate mortgage arm. Low rate first 5-7 years. Then rate resets. Can spike suddenly. Many Americans got destroyed in 2008 because of ARMs. Rule of 2026. If you don't understand ARM math, don't touch it. It's 2026, and while the housing market has evolved, the fundamental math of mortgages remains a high-stakes game. Choosing between a fixed rate and an adjustable rate mortgage arm isn't just about the monthly payment. It's a bet on your future income and the global economy. Here is the breakdown of why one is a security blanket and the other is a financial lever. The fixed-rate mortgage, the sleep-well-at-night option. With a fixed-rate mortgage, the interest rate is locked in for the entire life of the loan, usually 15 or 30 years. How it works: if you lock in at 5.5%, you pay 5.5% until the very last check is written. The advantage: total predictability. If inflation spikes or the Federal Reserve raises rates to the moon, your payment stays exactly the same. The trade-off: you pay a certainty premium. The starting interest rate is almost always higher than an ARM because the bank is taking the risk that rates might rise later. Best for people staying in their forever home, families on a strict budget, and anyone who remembers the chaos of past market crashes. The adjustable rate mortgage arm, the calculated risk. An ARM is a hybrid. It starts with a fixed teaser period, usually 5, 7, or 10 years, with a rate is lower than a standard fixed mortgage. After that, the rate adjusts based on market indexes. The ARM math you must understand. An ARM is defined by numbers like 5/1 or 7/6. The first number, how many years the rate is frozen, for example, 7 years. The second number, how often the rate adjusts afterward, for example, once every 6 months. Why it's dangerous. When the reset hits, your rate is calculated as the market index has spiked. Your monthly payment could jump by hundreds or even thousands of dollars overnight. This is what destroyed homeowners in 2008. They assumed they could refinance before the reset, but when home values dropped, they were trapped in payments they couldn't afford. Best for professional house flippers, corporate climbers who know they are moving in 3 years, or sophisticated investors with high cash reserves. The rule of 2026. If you are looking at an ARM simply because it's the only way you can afford the monthly payment today, you cannot afford the house. An ARM should be a strategic choice to save interest over a short period, not a Hail Mary to get into a home you'll lose when the rate resets. Qualification versus affordability. There is a massive difference between what a bank says you can borrow and what your lifestyle can actually sustain. The trap: if the lower introductory payment of an ARM is the only way your debt-to-income DTI ratio works, you have zero margin of safety. The reality: financial stability requires a buffer for home maintenance, emergencies, and inflation. If the mortgage consumes every spare cent at the lowest possible rate, any slight increase in the future will lead to default. 2. The mechanics of the reset. ARMs typically have a fixed period, for example, 5, 7, or 10 years before they begin to adjust based on market indices. Strategic use: a buyer who knows they will relocate in for years might use a 5-year ARM to pay less interest, intending to sell before the rate ever moves. The Hail Mary: a buyer who plans to stay for 30 years but hopes rates will just go down by the time the reset hits. If rates stay flat or rise, the monthly payment could jump by hundreds or even thousands of dollars. 3. The refinance myth. Many buyers justify an affordable ARM by saying, "I'll just refinance into a fixed rate later." This assumes to things that are never guaranteed. Who decides your mortgage rate? Your rate depends on you. Factors: credit score most important, income stability, debt-to-income ratio, down payment, loan type, market timing, credit score impact. 760 plus best rates, 700 higher cost, 620 painful, below 600 almost impossible. 1 mistake: late payment. Maxed credit card can cost you $100 or 00 plus over 30 years. Most Americans believe one dangerous myth: mortgage rates are decided by banks. That is only half the truth. Yes, the Federal Reserve controls the base environment, but your personal mortgage rate is decided by you, your financial behavior, your discipline, and your mistakes. 2 people can apply on the same day, at the same bank, for the same house, and still get very different mortgage rates. Why? Because lenders are not lending houses. They are pricing risk. The core rule: very important. A mortgage rate is simply the bank answering one question: how risky is lending money to you for the next 30 years? If you look safe, lower rate. If you look risky, higher rate. If you look dangerous, rejection. Now let's break every factor down clearly. Credit score: most important factor. Your credit score is your final reputation. It answers 3 questions for the lender. Do you pay on time? Do you borrow responsibly? Can you be trusted for 30 years? How credit score affects your mortgage rate. 760 plus excellent. Best possible mortgage rates. Lowest monthly payment. Lowest total interest. Banks compete to lend to you. 759 good. Still approved easily. Higher interest than top tier. Cost stands of thousands more over time. 699 fair. Approval becomes difficult. Rates jump sharply. Monthly payment becomes painful. Below 600 poor. Many banks reject instantly. If approved, interest is extremely high. often requires large down payment or cosigner. Reality check. A difference of just 40-60 credit score points can cost you $100,000 plus over a 30-year mortgage. One mistake and destroy your rate. Lenders don't look at intentions. They look at history. Late payments. Even one late payment can drop your score. Recent late payments hurt the most. Mortgage lenders hate inconsistency. Maxed credit cards. High credit usage equals high risk. Even if you pay on time, maxed cards signal stress. 30% usage rule matters more than income. Someone earning $150,000 with maxed cards can look riskier than someone earning $60,000 with clean credit. Income stability. Banks don't care how much you could earn. They care how stable your income is. What lenders prefer? W-2 job. Same field 4 to plus years. Predictable income. What raises red flags? Frequent job changes. Self-employed with fluctuating income. Recent career switch. Large gaps in employment. Even high earners get rejected if income looks unstable. Truth. A stable $70,000 income often beats an unstable $120,000 income. Debt-to-income ratio. Debt DTI shows how much of your income is already spoken for. Formula simple. Monthly debt, monthly income. What lenders want? Under 36% excellent. 36%, 43% acceptable. Above 43% dangerous. Your debts include credit cards, car loans, student loans, personal loans. High DTI means less room for mortgage payment, higher chance of default, higher mortgage rate. Down payment. Down payment tells the bank how much risk are you taking. Higher down payment equals lower risk. 20% plus best rates, no PMI. 10-19% higher rates. 3-5% very expensive loans. Low down payment means you have less equity. You can walk away easier. Bank takes more risk, so they charge you more. Loan type matters. Different loans equal different risk levels. Conventional loans. Best rates. Strict credit requirements. FHA loans. Easier approval. Higher insurance costs. Higher long-term cost. VA loans. Very low rates. Only for veterans. Government backing. The loan you choose affects interest rate, monthly payment, total lifetime cost. Final truth very important. Your mortgage rate is not punishment. It's a report card. Banks don't care about your dreams, your excuses, your emotions. Should you buy a house in 2026? This is the question everyone asks. Buy only if stable job, emergency fund, low debt, long-term plan 7+ years. Do not buy if FOMO, social pressure, rates will drop later thinking, barely qualifying. You don't buy a house when you're scared, you're rushed, you're broke. Renting is not failure. Buying wrong is. This is the question everyone in America is asking right now. Should you buy a house in 2026? Or should you wait? Because on one side people say, if you don't buy now, you'll be priced out forever. And on the other side people warn, mortgage rates are too high, this is the worst time. The truth is uncomfortable, but simple. Buying a house is not about the market. It's about your personal financial position. Let's break this down slowly and honestly. Buy a house only if these conditions are met. Stable job. A stable job doesn't mean just having a job. It means predictable income, low risk of sudden layoffs, skills that are still valuable, industry that isn't collapsing. In 2026, layoffs are no longer rare events. Tech, media, retail, logistics, nothing feels permanent. A mortgage is a 30-year commitment. If your income isn't stable, the house becomes a threat, not security. A bank will approve you based on today's paycheck, but they don't care what happens next year. You must. Emergency fund. Most people ignore this and pay the price. An emergency fund means 3 to 6 months of total expenses, sitting in cash, not invested, not tied to credit cards. Why? Because homeownership is full of surprises. Roof leaks, havoc breaks, property tax jumps, insurance increases. When renters face a problem, they call the landlord. When owners face a problem, they open their wallet. If one unexpected expense can push you into debt, you are not ready to buy. Low debt. Low debt is not about being debt-free. It means credit cards under control, car payment reasonable, no lifestyle loans. Debt doesn't control cash flow. In 2026, mortgage payments are already heavy. Add high debt on top, and your monthly budget starts suffocating. Many homeowners fail not because the house is expensive, but because everything else already was. A house should fit into your life, not crush it. Long-term plan 7+ years. Buying a house only makes sense if you plan to stay. Why? Because the first years of a mortgage, mostly interest, very little principal, high transaction costs. If you sell too early, you lose to closing costs. You lose to commissions. You lose to market timing. In a high-rate environment like 2026, short-term ownership is risky. Buying only works when time is on your side. Do not buy a house if any of these apply. FOMO, fear of missing out. FOMO is one of the most dangerous financial emotions. It sounds like everyone else is buying. Prices always go up. This is my last chance. But history shows something brutal. People who buy emotionally usually buy at the worst time. Homes are not stocks. They are not lottery tickets. Buying out of fear locks you into decades of stress. Social pressure. Your friends buying homes does not mean you should. Your family pushing you does not pay your mortgage. Your Instagram feed does not cover your repairs. Social pressure forces people to buy too big, buy too early, buy too expensive. A house bought to impress others becomes a lifelong burden. Your financial life must match your reality, not someone else's timeline. Rates will drop later thinking. This is one of the most dangerous assumptions. People say, I'll buy now and refinance later. But reality, rates may stay high longer. You may not qualify later. Home value may not rise. Refinancing costs money. Hope is not a strategy. If the numbers don't work today, they won't magically fix themselves tomorrow. Final truth. Renting is not failure. Renting gives flexibility, lower risk, predictable costs, freedom to move. In uncertain economic times, renting can be the smartest financial move. Buying wrong is buying the wrong house at the time. Refinancing truth. People say, I'll refinance when rates drop. Reality. Rates may stay high longer. Refinancing costs money. Many never qualify again. Refinance only when rate drops by at least 1%. You stay long-term. Closing costs make sense. People say I'll refinance when rates drop. Most homeowners believe refinancing is automatic and easy. They think once rates fall, the bank will simply reduce their payment. Reality. Refinancing is a brand new loan, not a button you press. The bank rate checks credit score, income, job stability, debt levels, home value. If anything is worse than before, you may not qualify at all. Reality check most people ignore. Rates may stay high longer. People expect rates to fall quickly. But the Federal Reserve controls rates, not homeowners. In 2026, inflation is still risky. The Fed moves slowly. Low rates may take years. Waiting for soon can mean waiting forever. Refinancing costs money. Refinancing is not free. Typical refinance costs: loan origination fees, appraisal fees, title insurance, closing fees. Cost range to 5% of loan amount. On a $300,000 loan, $6,000 to $15,000 upfront. If savings don't beat this cost, refinancing is a loss. Many never qualify again. Life changes, job loss, lower income, higher debt, credit score damage. Even one late payment can destroy refinance eligibility. Many homeowners are stuck paying high rates forever because they assumed refinancing was guaranteed. Refinance only when very important. Rate drops by at least 1%. Small drops don't matter. Example: 7.5%, 7.0% not enough. 7.5%, 6.5% meaningful. A 1% drop usually covers closing costs, creates real monthly savings, makes refinancing worth it. Anything less is usually noise. You stay long term. Refinancing only works if you stay in the home long enough to recover the costs. Example: refinance cost $10,000. Monthly savings $200. Break-even time 50 months approximately for years. If you sell or move before break-even, you lose money. Closing costs make sense. Always ask, how much am I paying up front? How long until I recover that money? Will my life stay stable that long? If math doesn't clearly win, don't refinance. Banks make money on refinancing. Smart homeowners run numbers. Final refinancing truth: refinancing is a strategy, not a hope. Hoping rates fall. Assuming banks will help. Ignoring costs. Planning. Strong credit. Long-term thinking. A bad refinance can't wrap you. A smart refinance can save tens of thousands. Hidden costs most people ignore. Mortgage total cost. Hidden costs: property taxes, insurance, HOA fees, maintenance, repairs, rising taxes. A $2,000 mortgage can become $3,000 real cost. That's how middle-class families get crushed. Hidden costs most people ignore. Mortgage total cost. Most Americans think one thing: if I can afford the mortgage payment, I can afford the house. That belief destroys finances. Your mortgage payment is only the beginning, not the full cost of owning a home. Banks love when you think this way because it keeps you borrowing more than you should. A house has layers of expenses. Some are obvious. Most are silent. Let's break them down one by one. Property taxes biggest shock. Property tax is not optional. You don't negotiate it. You don't escape it. In the USA, property tax is based on home value. As prices rise, taxes rise. Counties reassess regularly. Example: mortgage to $0.000 month. Property tax for $100, $800/month. And here's the danger: property taxes can increase every year, even if your mortgage doesn't. Many homeowners are forced to sell not because of the mortgage, but because taxes became unaffordable. Insurance always rising. Home insurance is another cost people underestimate. You must pay for homeowners insurance, flood insurance in some states, hurricane or wildfire coverage. Insurance companies are raising premiums because of climate risk, natural disasters, repair costs. What starts as $120/month can quietly become $250 $400/month, and you must pay it. The bank requires it. HOA fees silent monthly drain. HOA fees look small at first. $100 to $100 and maybe $300 per month. But HOAs increase fees, add special assessments, charge fines. You could suddenly owe $3,000, $10,000 for repairs, even if you didn't cause the problem. HOAs have power and little mercy. Many Americans regret buying because of HOA rules, not the house. Maintenance homes age, always. Renters call the landlord. Owners pay the bill. Maintenance is constant. Plumbing leaks, electrical issues, havoc servicing, roof wear, appliance replacement. Rule of thumb: 1–3% of home value per year. On a $400,000 home, $4,000, $12,000 annually, $330, $1,000 monthly. This cost never stops. Repairs the financial punch. Repairs are not if, they're when. Examples: roof replacement $10,000, $25,000. AC system $6,000, $12,000. Foundation issues $20,000 plus. These bills arrive without warning. Most middle-class families use credit cards, take personal loans, refinance. That's how debt snowballs. Rising taxes and fees, the long-term trap. Cities raise property taxes, utility fees, local charges. Why? Infrastructure, schools, budget gaps. You pay forever. Your income may stay flat. Your housing cost doesn't. The reality check. Let's put it together. Mortgage payment, $2,000. Add very side. Property tax $600. Insurance $250. HOA $200. Maintenance and repairs $300. Real cost $3,350 per month. That's not rare. That's normal. Why middle-class families get crushed? They didn't fail. They were never shown the full picture. They bought at the top of their budget. They ignored hidden costs. They had no margin. One job loss, one medical bill, one major repair, and the house becomes a financial prison. Final warning: owning a home is not just pride, it's responsibility. If you can afford only the mortgage, you cannot afford the house. Smart buyers plan for today's payment, tomorrow's surprises, next decade's reality. That's how you survive and win in 2020-26. Future of mortgage rates. No one controls rates except the Fed. Likely scenarios: slow gradual drops, no return to 3%, higher normal rates. The era of cheap money is over. Smart Americans: buy smart, borrow less, build credit, stay flexible. The question every American is asking. Everyone wants the same answer. When will mortgage rates come down? Homebuyers are waiting. Renters are confused. Homeowners are hoping. But here's the uncomfortable truth. Most Americans are waiting for something that may never come back. Today, we're going to talk honestly about who actually controls mortgage rates, what the future scenarios really look like, why 3% mortgages are likely gone forever, and how smart Americans should adapt. This is not hype. This is reality. No one controls rates except the Fed. Let's clear the biggest myth first. Banks do not control mortgage rates. Real estate agents do not control rates. The president does not directly control rates. The Federal Reserve does. What the Fed really does: sets short-term interest rates, controls money supply, fights inflation, slows or speeds the economy. When inflation is high, the Fed raises rates. When inflation is low, the Fed lowers rates. And right now, the Fed's priority is control, not comfort. High rates are not an accident. They're a policy choice. Why the Fed can't cut fast? Many people believe rates will crash soon. But here's why that thinking is dangerous. Inflation damage still exists. Food prices never fully came down. Rent is still high. Insurance costs exploded. Wages rose unevenly. If the Fed cuts rates too fast, spending spikes again. Inflation comes back stronger. The economy overeats. That would destroy trust in the dollar. So the Fed moves slowly. Painfully slowly. Slow, gradual drops. This is the most realistic future. Mortgage rates may drift down slightly. Pause. Then move again. Think. 7%, 6.5%, 6% over years, not months. Not thilsilian. 7%, 3% overnight. Why? Because the Fed wants stability, predictability, control. This means buyers waiting for a perfect rate may wait forever. No return to 3%. This is the hardest truth for Americans to accept. The 3% mortgage era was abnormal. It was created by emergency money printing, crisis-level stimulus, artificially cheap borrowing. That environment is gone. Historically, 6-8% mortgage rates are normal. Cheap money was the exception, not the rule. Expecting 3% again is like expecting gas at $1. Free money. Zero inflation. It's emotional hope, not economic reality. Higher normal rates. This is the new world. In this world, borrowing costs stay higher. Home prices adjust slowly. Buyers must qualify properly. This benefits disciplined buyers, strong credit holders, long-term planners, and it hurts speculators, overborrowers, FOMO buyers. The market is shifting from easy money to smart money. The era of cheap money is over. This sentence changes everything. Cheap money created bigger homes, bigger loans, bigger risks. Expensive money forces smaller loans, better decisions, real affordability. This is not bad. It's a reset. Homes become places to live again, not gambling chips. What smart Americans do differently. This is where winners separate from losers. Buy smart. Smart buyers buy within budget. Ignore hype. Plan long term. They don't ask, how much can I qualify for? They ask, what keeps my life stable? Borrow less. Every extra dollar borrowed increases interest, increases stress, increases risk. Smart Americans put more down. Choose affordability. Avoid stretching. They understand a smaller loan equals bigger freedom. Build credit. In a high-rate world, credit score is power. A higher score means lower rate, lower payment, better approval. Smart people pay on time. Keep balances low. Avoid emotional spending. Credit is not a number. It's leverage. Stay flexible. Flexibility is survival. Smart Americans don't rush. Don't panic. Don't lock into bad deals. They rent if needed. They wait if smart. They move when ready. Homeownership is not a race. It's a strategy. Final warning and conclusion. A mortgage is not a dream. It's a 30-year legal contract. The bank wins if you don't understand. Overborrow. Panic buy. You win if you plan. You wait. You stay disciplined. The house should serve your life, not control it.